What if the reason gold and silver feel out of control lately isn't that the world became random, but that the market's behavior changed and most people are still trading it like it hasn't? Same assets, same tickers, same chart, different behavior. And here's the missing piece most people don't say out loud. Flows, headlines, and thin liquidity are colliding more often, so the market is moving in bursts, snapping and reversing in ways that punish anyone who expects a smooth story. Now I'm going to give you something usable within the first 30 seconds, because this is the tell that stops the most damage. When gold or silver makes a big move, don't ask why first. Ask, does it hold the ground, or does it give it back fast? That one behavior, hold versus give back, will tell you more about what kind of day you're in than any hot take. Here's what you're getting in this video, clean and simple. I'm going to explain the 3 engines that are driving metals volatility lately, the Yin 3 tells you that let you spot which engine is in control, and an 60-second protection checklist. You can run today so you stop letting volatility bully your portfolio, because the real danger isn't volatility on its own. The real danger is volatility creating urgency, and urgency creating a bad decision you can't undo. Let's define volatile the way it actually behaves, not the way it sounds. Volatility is the market repricing risk faster than your brain can update. That's why it feels personal. That's why it feels unfair. That's why it feels like the market is messing with you. But the market isn't targeting you. It's targeting structure, where the stops are, where the forced sellers are, where the liquidity is thin, where the crowd is leaning the same way. And gold and silver sit right on top of the most sensitive fault lines in global markets: currencies, rates, fear, inflation expectations, geopolitics, and leverage. So when the environment gets jumpy, metals become a stress test. Now one sharp contrarian line, once, and then we move on. Safe haven doesn't mean safe experience. Gold and silver can be long-term protection and still be brutal short-term rides. If you buy them expecting calm, you'll sell them in fear the moment they behave like metals. Now we build the explanation with the minimum number of moving parts. 3 engines. That's it. Engine 1, flow volatility. Engine 2, narrative volatility. Engine 3, liquidity volatility. If you can learn to recognize which engine is driving the move, you'll stop reacting the wrong way. Because most losses in volatile metals don't come from being wrong about gold. They come from responding incorrectly to the engine that's in control. Let's start with flow volatility, the one that moves markets without giving you a satisfying headline. Flow volatility is when price is being driven by positioning and risk management, not by a new discovery about gold, not by someone suddenly deciding silver is over. By exposure changing, funds rebalance, risk models de-risk, options hedging shifts, stops get triggered, participants reduce risk because their process tells them to, not because their worldview changed. And the reason this matters is because flow-driven moves often confuse people the most. They say nothing happened, but price moved, something did happen, flow happened, positioning happened, and lately flow sensitivity has been higher. When the market is already tense, small flow shifts create larger moves. When moves get larger, risk systems respond harder. When risk systems respond harder, moves get larger again. That loop is how you get, why did it do that? Days. Now narrative volatility, the one that feels obvious but is often misleading. Narrative volatility is when words move the market. Headlines, speeches, rumors, geopolitical developments, policy talk, inflation prints, rate expectations, anything that triggers a story people can trade. Gold and silver are magnets for narratives because they're tied to fear and protection. When people feel uncertain, they reach for metals. When people feel certain, they drop them. When people feel confused, they whipsaw them. Narrative volatility has a signature. The market reacts fast to a story, then corrects when details don't match the first emotional interpretation. That's why you see spikes that vanish and dumps that reverse. Not because the market doesn't know what it's doing, because the market changed its mind in public. Now liquidity volatility, the silent engine that turns normal, moves into shock moves. Liquidity volatility is when the market's ability to absorb buying and selling changes, not because of a philosophical shift, because orders disappear, spreads widen, depth thins, and the order book becomes fragile. Gold is generally deep, but even deep markets can get patchy at the wrong time. Silver is thinner by nature. It doesn't take much for silver to become a gappy, snappy instrument, especially around session transitions and stress events. Thin liquidity does one simple thing. It makes price move farther for the same push, and when price moves farther, it hits more stops, and when it hits more stops, it creates more flow, and that's how you get air pockets and snapbacks. Now, I promised 3 tells that let you spot which engine is in control. Here they are. Tell 1, hold versus give back. After a big move, does gold or silver hold the new ground, or does it quickly give it back? Holding means the new price is being accepted by real repositioning, by real demand, by participants willing to defend. Giveback means the move was an emotional reaction or flow burst that got exhausted. This is the cleanest tell because it requires no special tools. You can see it on any chart, any time frame. Tell 2, wicks and whips. Do you see long wicks up and down, both sides, repeatedly? That usually means the market is hunting liquidity. It's probing above and below, triggering emotional entries and stops, then reversing. Here's the actionable response you asked for, attached directly to the tell. If you see long wicks both ways, don't add, don't chase, and don't size up. Either wait or reduce exposure. Whip conditions punish conviction. Tell 3, speed and snapback. Does the market move fast through levels and then snap back violently? That's liquidity stress interacting with forced behavior. It's the signature of a shove through a thin book, followed by a recoil when the shove runs out of fuel. Fast move plus snapback is not a calm repricing. It's a clearing event. Now we connect the tells to the engines in a way you can use. If moves are grinding and holding, flow volatility is often dominant, real repositioning. If moves are headline spikes that reverse when the story cools, narrative volatility is dominant. If moves are fast, gappy, and snapping, liquidity volatility is dominant. That's the map. And now we make it personal because understanding volatility is worthless if you still react wrong. The way volatility hurts portfolios isn't mysterious. It's always the same sequence. Volatility spikes, urgency rises, a decision gets made too fast, the decision becomes permanent. Then the market does what volatile markets do. It reverses, snaps back, or keeps chopping. And the investor either locks in loss or pays a whipsaw tax or abandons the plan. So portfolio protection is not about predicting the next move. It's about breaking that sequence. Now, I'm going to give you a mini scene you asked for, early, relatable, and painful, because this is the pattern most people live through. You're watching the news and a scary headline hits. Everyone posts charts. Everyone says, this is it, gold and silver spike. You feel the pressure, that fear of missing, that fear of being unprotected, that fear of being late. So you buy the spike, and then the market cools, or liquidity normalizes, or the story gets clarified, or the risk-on crowd steps back in. The spike gives back. Now you're holding pain, and the story that made you buy already changed. That's narrative volatility eating you alive. That's why protection starts with one simple discipline. You don't buy protection when you feel maximum fear. You buy it when you're calm enough to size it correctly. Now a second mini scene, different trap, because this is the one that bleeds people quietly. You wake up and see silver down hard. You feel that sick urge to stop the pain. You sell. Then it snaps back the next day because the move was liquidity stress and forced selling, not a new long-term truth. Now you feel regret. So you buy back higher. You just paid a volatility tax, not once, twice. This is how people lose money in a market they technically believed in. Not by being wrong about metals, by reacting to the engine. Now we get to the practical part of the title. How do you protect your portfolio? I'm not going to drown you in 10 frameworks. You were right. Cognitive load kills retention. So we use one support tool, the 60-second checklist. That's it. But first, one line of segmentation, compressed because it matters and it's not a detour if we keep it tight. Core you don't touch emotionally. Tactical you adjust. Spec is optional. That's all. Now here's your 60-second protection checklist. You can run it during any volatile metals day. First, what engine is driving this move right now? Flow, narrative, or liquidity? Use the tells, hold versus give back, wicks both ways, speed and snapback. Second, what role does my metals exposure play? Insurance, a core, tactical hedge, speculative upside? If you can't answer that in one sentence, you're exposed to emotional decisions. Third, is my size compatible with this engine? If volatility is whipping and you're oversized, you're not investing, you're being held hostage. Fourth, am I about to act because I feel urgency? If yes, pause. Wait for hold or give back confirmation. That's the checklist. Notice what's not in the checklist. No predictions, no magic levels, no experts say, just structure. Now let's make the checklist even more usable by tying responses to the engines. If narrative volatility is dominant, headline spikes and reversals, your protection behavior is simple. Don't chase the first move. Let the market show hold or give back. If it gives back fast, it wasn't a stable repricing. If liquidity volatility is dominant, fast moves and snapbacks, your protection behavior is reduce activity, avoid tight stops and chaotic hours, and don't size up into a thin book. You let the market normalize before you make big decisions. If flow volatility is dominant, grinds and holds, your protection behavior is adjust only after confirmation. Not on the first candle, not on the first tweet, on the hold. Now I'm going to give you a short, memorable line that replaces a bunch of repetition. In volatile metals, the first move is a proposal, the hold is the vote. That's it. Proposal versus vote. If the move holds, the market voted yes. If the move gives back, the market voted no. Now we need to address gold and silver separately for one reason. They don't punish you the same way. Gold is generally less volatile than silver. Silver is an amplifier, so portfolio protection often means you don't treat them like twins. Gold can be the calmer anchor for insurance exposure. Silver, if you hold it, should usually be smaller and treated like tactical or upside exposure, not the emotional foundation of your security, because if silver is your emotional foundation, it will shake you more often. That's not an opinion. That's the nature of a thinner, more flow-sensitive market. Now, I want to handle the most common misunderstanding that creates endless arguments. People hear gold is safer and think it means gold can't drop. Wrong. Gold can drop. Gold can gap. Gold can whip. But it tends to do it less violently than silver. So protection isn't about eliminating drawdowns, it's about reducing the odds that drawdowns force catastrophic behavior. Now let's talk about the protection habits that matter most without turning it into a long list. 2 habits. Habit 1. Position size is chosen for your worst emotional day, not your best confident day. Most people size positions when they feel optimistic, then volatility arrives and they discover their tolerance was fantasy. Habit 2. You pre-decide what you do in each engine. So you don't improvise under stress. Improvisation under stress is where humans do their worst work. Now, I'm going to make that vivid with one more short scene, because this is where portfolios get destroyed. You see gold down, silver down, stocks down, everything feels red. Your brain interprets that as danger, so you liquidate what feels painful. But what you actually did was sell into a liquidity event, then the market stabilizes, and now you're out, mentally and financially, right before the conditions normalize. That's not a market problem. That's a decision sequence problem. Protection is fixing the sequence. Now let's address the why lately part again, but with a sharper proof-like vibe without getting lost. Metals volatility spikes when these conditions cluster. More event risk, more positioning sensitivity, more liquidity fragility. You don't need a conspiracy to get a chaotic chart. You just need more participants reacting faster with less liquidity buffer in a market that carries global fear. That's what lately often means. The same market with less tolerance for surprise. Now, the one place I see people confuse themselves is here. They think volatility means the thesis is wrong. Sometimes, not always. Volatility often means the market is clearing weak positioning. That's why you must separate the asset from the behavior. The asset can be part of a good long-term plan. The behavior can still torture you short-term. And torturing you short-term is how the market forces bad decisions. Now, we anchor this back to your portfolio with the cleanest possible protection rule. If you can't hold it through the engine you're currently in, you're too big. That's it. And it applies whether you're 25 or 65. Now, I'll place the one-line credibility note here and never mention it again. I sell nothing. No paid alerts, no VIP. This is market structure education. Back to the work. Let's talk about one more trap that shows up in volatile metals. Adding complexity when you should be adding discipline. When volatility rises, people reach for solutions. They add leverage. They add options without understanding the Greeks. They add inverse products. They hedge a hedge with another hedge. Complexity can reduce risk if you know what you're doing. But for most people, complexity increases risk because it creates more ways to be forced out, more places to panic, more moving parts to misunderstand. So here's a protection principle that sounds boring but saves accounts. In volatility regimes, simplicity is protection. Clear roles, honest size, fewer impulsive actions, rules you can actually follow. Now, I want to give you 3 actionable responses tied directly to the 3 tells, so the script is not just explanation. If you see hold behavior after a move, pullbacks shallow, price defending, then it's reasonable to treat that as a real repricing environment. You still don't chase the first candle, but you stop assuming every move is fake. If you see Giveback behavior, big spike, quick reversal, then you treat it like narrative flow or liquidity burst. You reduce activity, avoid adding into emotion, and you wait. If you see it on long wicks both ways, you reduce size or you step back. You do not try to outsmart a liquidity hunt with more aggression. That's protection. Now let's bring it home to the investor who holds metals for insurance and keeps getting tempted to do something during volatility. Here's the key. Insurance is not something you manage every hour. Insurance is something you hold so you don't have to manage fear every hour. If you're constantly managing your insurance, it's not insurance. It's a trade. So protection starts with role clarity. Is your metals exposure insurance? If yes, you don't cancel it during a storm. Is your metals exposure tactical? If yes, you adjust only after holds and givebacks show you what kind of regime you're in. Is your metals exposure speculative? If yes, accept that it can be wrong quickly and plan accordingly. Now, a lot of people get stuck on the desire for a single clean answer. So should I be in gold or silver? That's not the right question for a protection mindset. The right question is, what mix of roles and sizes prevents forced decisions? And that's why the checklist matters. It pulls you out of the tell me what to do mindset and into the tell me how to behave mindset. Because markets punish tell me what to do. Markets reward I know how I behave under stress. Now I'm going to give you a short if-then script you can literally repeat to yourself when the market is moving fast. If this move holds, I respect it. If this move gives back, I don't chase it. If this market is whipping, I reduce activity. That's it. That is a protection plan you can actually execute. Now let's tighten the why lately portion with one more clean, memorable concept, and then we end. Gold and silver are volatile lately because more trading is being done by systems that respond to volatility, more capital is moving faster on headlines, and liquidity buffers aren't always there when everyone leans at once. Same market, different tempo, different fragility. And when tempo and fragility rise, volatility rises. So the solution isn't wishing volatility away. The solution is building a portfolio response that doesn't require calm markets to work. Now I'm going to close with a tight recap and nothing extra, because you asked for a tighter ending. Gold and silver are volatile lately because flow, narratives, and liquidity are colliding more often. You protect your portfolio by identifying which engine is in control, using 3 tells: hold versus give back, wicks both ways, speed and snapback. Then you run the 60-second checklist. Name the engine, name the role, check the size, refuse urgency, wait for confirmation. And if you want one line that keeps you safe in the moment, it's this. The first move is a proposal. The hold is the vote. If this helped you see volatility as structure, not chaos, drop structure over urgency in the comments so I know you're here for frameworks, not adrenaline. This is market structure education, not financial advice.